Wall Street just got the inflation relief it was waiting for, but the bigger question is whether the S&P 500 is heading toward 8,200 or approaching a major market top. To figure that out, we need to look closely at the fresh CPI numbers that just dropped, how they are completely shifting Federal Reserve expectations, and exactly why Treasury yields and the US dollar are moving lower as a result. Let's get right into the data.
Section 1. Inflation Data and Fed Outlook. The CPI's sigh of relief.
Here is the exact macro data acting as the engine for our current market sentiment. Headline CPI came in up 0.1% month over month, which brings the year-over-year figure to 3.4%. Now, for core CPI, which strips out those volatile components, that printed at up 0.2% for the month and 2.5% year-over-year. And here is why the market breathed a massive sigh of relief. These numbers matched market consensus perfectly. We saw absolutely no nasty upside surprises to spook investors.
Looking under the hood, shelter remains the undeniable heavyweight here, making up a massive 2/3 of the total monthly inflation gain. On the flip side, though, energy actively declined, finally giving consumers a bit of a break. Food ticked up just 0.1%, although dining out saw a slightly higher bump of 0.3%. Now, notice the stark contrast in the services sector. Airline fares jumped 2.2% for the month, which is actually a staggering 25.5% increase year over year, and medical services rose 0.4%. But auto insurance did provide some unexpected relief by dropping 0.3%.
Because those inflation numbers came in right on the money, the probability matrix for the September 16th Federal Reserve meeting has fundamentally shifted. Previously, the odds of a rate hike versus a pause were basically a coin toss. Now, we are looking at a 55.9% probability of a pause versus just a 44.1% chance of a rate hike. You know, the Fed might keep up a tough rhetorical stance on inflation when they do press conferences, but this underlying data tells a totally different story. A softening labor market makes another hike incredibly difficult to justify economically. Plus, the political pressure is really mounting. Hiking rates right on the heels of weak jobs data would likely cause some serious friction with the executive branch.
And you can see the bond market is already placing its bets. The 10-year Treasury yield has fallen down to 4.656%. This declining yield, running parallel with a declining US dollar, brilliantly illustrates that the smart money is actively pricing out further rate hikes for the rest of the year. They are looking right past the Fed's tough talk and zeroing in on this softening data, which is really paving the way for potential rate cuts down the road.
Section 2. S&P 500 Target and Risks. Bullish Breakout versus Systemic Warnings.
Right now, we are at a fascinating technical juncture where short-term momentum and long-term history are violently clashing. The short-term bullish case shows the S&P 500 forming a very strong consolidation pattern. If it breaks out, that points to a highly realistic 6% upside move toward the 8,100 to 8,200 level. But a long-term warning is flashing bright red. When you analyze the S&P 500, adjusted for the M2 money supply, which accounts for the devaluation of fiat currency, the index is approaching massive historical parallel channel resistance that dates all the way back to the dot-com highs. So a short-term 6% rally is absolutely in play, but we might simultaneously be forming a major systemic market top.
If you're finding this market breakdown useful, make sure to subscribe to Fox of Wall Street, share this explainer, and like it. It helps the channel bring you more data-driven market analysis.
Moving on to Section 3, AI and Semiconductor Momentum, Key Breakout and Resistance Levels. Earnings and aggressive forward guidance are completely revitalizing the AI sector right now. If you're trading this momentum, these are the critical technical levels you need to watch. CoreWeave surged roughly 20% on earnings, but it's staring down a major resistance level at 122. Meanwhile, SMCI provided guidance that was an incredible 35 to 40% above consensus. You want to watch for reactions at 36.75, 38.15, and 40.50. Outside of tech, Kava is putting up strong earnings, noting the return of middle-income diners, with upside resistance sitting at 74.40 and 76.75. Finally, NBIS jumped nearly 20%. Day trading resistance is incredibly tight at 240.80 to 241, but clearing that opens up a swing trade target way up at 275.
The crucial point to remember here is that this kind of explosive strength doesn't just happen in a vacuum. The massive upside momentum we're seeing in these specific AI and semiconductor leaders acts as a really powerful catalyst. It ripples out across the entire market, providing a strong underlying bid to support the broader semiconductor and hardware sector. And that brings legacy names like SanDisk and Micron right along for the ride.
Let's turn to Section 4, Precious Metals and Energy Markets. Commodities Testing Critical Zones.
Right now, both gold and silver are pushing aggressively against upside resistance, but the technical setup in silver is highly compelling. Silver has officially broken its descending trend line. In technical trading, any short-term retracement back down to test that broken line is often viewed as a classic scene of the crime buying opportunity. Over in equities, the GDX Gold Miners ETF is showing some excellent upward momentum, though it is rapidly approaching a notable resistance wall near 94.
Over in the energy markets, it is a tale of two entirely different technical environments. Crude oil is strictly range-bound, chopped up in a tight technical wedge pattern dictated by the geopolitical stalemate between the US and Iran. Since it lacks a definitive catalyst, prices remained frustratingly sideways. But contrast that with natural gas, which is actively testing a very clear short-term resistance level at 2.83. The setup here is pretty binary. A daily close above 2.83 triggers a direct target of $3. If it fails, we'll be looking for a return to longer-term trendline support.
Section 5. Bitcoin Technical Outlook. Holding the breakout trend.
Bitcoin has had to endure some serious overhead supply recently. It is absorbing heavy selling pressure, driven in part by major liquidations from prominent holders like Michael Saylor's Michael Saylor. But despite that intense selling volume, Bitcoin's technical posture remains firmly bullish for one very simple reason. It is still holding its primary breakout trend line. As long as BTC holds above that specific line on the chart, the probability strongly favors continued upside. However, make no mistake about it, losing that primary trend line would instantly invalidate this technical outlook and signal a massive, immediate shift in market sentiment.
So let's pull all these macro and technical threads together. We have immediate, palpable relief from inline CPI data that is fundamentally shifting the odds toward a September Fed pause. This macro relief is what's fueling a short-term bullish consolidation in the S&P 500, heavily supported by intense, earnings-driven momentum in AI and semiconductors. Concurrently, we have Bitcoin stubbornly holding its critical breakout trendline, and key commodities like silver and natural gas pushing right up against major actionable technical lines. But hanging over this entire bullish setup is that M2 money supply analysis, which is flashing a severe, long-term systemic market top warning. Which brings us to the ultimate question. Is Wall Street entering another powerful upside phase, or is this rally moving closer to a major resistance zone? The next moves in inflation, Treasury yields, the Fed, and price action could determine which scenario wins.
This explainer is for educational and informational purposes only and should not be considered financial advice. Always conduct your own research and consider your individual financial circumstances before making investment decisions.